Good morning, my dear students. I'm Miss Tania Poveda, and this is Entrepreneurship 1. Welcome back. Remember to download this information or save this link so you can check it whenever you need. We have been talking about financial terms. The last class, we were talking about investment. Do you remember anything about this? Well, in case you don't, let's read a little bit about this. When we talk about investment, we're talking about on the attempt to stimulate production by means of capital goods that are either created or acquired. All right, in other words, it's a way to increase, or I like this word, stimulate production by putting some money, energy, or capital. It can be goods or maybe services, or it can be cash. So you can grow, you can sell more, and you can hire more people and spend more money on your business. All right, so that's investment. This is a representation about investing. When we talk about investing or investment, we are not talking about only money or cash. We also talk about time and energy. So why do we invest money, or why do we invest time, or why do we invest energy? For a future benefit. Like right now that you are watching this video, you're actually spending your time and your energy. And yes, your money too, because you're paying your internet. So yes, this is costing you. But what you're actually doing, you're investing on yourself to learn. For what? For a future benefit. That's exactly what you are doing right now as young people, as students. But when we talk about businesses, we're talking about money, we're talking about growing or increasing the production or increasing the sellings, right? Okay, so this is just a short review about investment. This was a video we watched last week, so you can watch it again. The link is right here. You can click on this in the PowerPoint presentation and watch it one more time. We are going to continue. We studied or we analyzed some of the advantages and disadvantages of investing, right? I'm not going to stop here one more time because we already checked it here. What it is important is to recognize that as everything in life, everything in your life and in my life, is that there is something good and something not too good. All right, so every time you have to take a decision, in this case about money or businesses, think about the advantages and the disadvantages before you take a decision, before you say yes or no to something. All right, take a decision with your brain, take a decision with numbers, not just because. Because investing, in my opinion, is always good. But sometimes you're going to find some disadvantages that probably you won't like. All right? It's very important we recognize that the only way that companies or businesses or entrepreneurs can grow is investing in their own businesses. If you have a business, you have a store, you have a shop, a restaurant, any kind of business, and you make money, congratulations, if that happens. But you take that money and you do nothing with that money. You just put it on the bank and then you spend it on weekends. Or even worse, you send the money to other country. In that case, the business is not going to grow. That's it. You're just using the money to pay debts, but not growing. But the opposite, you use the money that you make to invest on the business. You build another shop or you open another restaurant, and then you start investing on people, investing on machinery, on cars, on raw materials, on the things you need. In that case, your business is going to grow. That's why, in my personal opinion, investing is really, really good. Okay? Right now, your responsibility as students is to invest in yourself, acquiring knowledge. So invest your time and your energy on acquiring new things, on getting information for you to grow as a person, as a professional, and get benefits in the future. All right, so do you have any idea what we're going to talk about today? Probably not, right? I want you to watch this picture and think about what are we going to talk about today? Any idea? What is this? What comes to your mind when you see this kind of picture? All right, what about this one? Hey, what happened? So we had a beautiful basket with eggs and now, oops, we had an accident and they broke. All right, so probably you get the idea by now. And now, again, but now it's not only one basket, we have different baskets and the eggs are in different baskets. So now you have any idea what we're going to talk about today? If you said diversification, you are right. Today we are going to talk about diversification. As you can see here in the picture, we have different baskets. They represent different ways you can make money. You can see different ways of money. You have gold, you have bills, you have coins, and you put different kinds of money, different types of money in different baskets, right? So basically that's diversification. I'm going to show you one picture one more time. This one. This is diversification. This is diversification in the way we understand. Probably you have heard your parents or someone else talking about these kind of pictures, like when they say, okay, don't put all the eggs in one basket. Yes, that's exactly diversification. When we talk about businesses, we're talking about like, don't put all your money in only one business. Don't risk everything you have for one only reason. So you can diversify the risk. You diversify your money, you diversify the risk. All right, so we're going to watch a part of this video, not the whole video, because we don't have to. I only chose the first part of the video. Pay special attention because you're going to have a homework about this section. The homework is probably going to be in groups. I'm going to explain that in your emails, but pay special attention. Anyway, you can pause the video, you can watch it again. The link is here if you need to watch only this video one more time. There is no problem. Okay, and we're going to listen from other person what business diversification is. We're also going to listen types of diversification. And in the end, well, before I pause the video, he is going to explain about related and unrelated businesses. All right, so pay special attention so you can do your homework, but even better, you will understand, and in the future, you can diversify your money and grow your business. All right, are you ready? Here we go.
As long as a single business company can achieve profitable growth opportunities in its present industry, there's no urgency to pursue diversification. However, a company's opportunities for growth can become limited if the industry becomes competitively unattractive. Business diversification is about creating added value for shareholders via diversification and requires building a multi-business company in which the whole is greater than the sum of the parts. Business diversification stands little chance of building shareholder value without passing the following 3 tests. The industry attractiveness test. The industry must offer an opportunity for profits and return on investment that's equal to or better than the present business. The cost of entry test. The cost to enter the target industry must not be so high as to erode the potential for good profitability. And finally, the better off test. Diversifying into a new business must offer potential to perform better together. The means of entering new industries and lines of businesses can take 3 forms: acquisition, internal development, or joint ventures with other companies. Acquisition is a popular means of diversifying into another industry. Not only is it quicker than trying to launch a new operation, but it also offers an effective way to hurdle entry barriers. Buying an ongoing operation allows the acquirer to move directly to the task of building a strong market position in the target industry, rather than getting bogged down in the fine points of launching a startup. Achieving diversification through internal development involves starting a new business subsidiary from scratch. Generally, forming a startup subsidiary to enter a new business has appeal only when the following 4 things are true. The parent company already has most or all of the skills and resources needed to compete effectively. There is ample time to launch the business. Internal entry has lower costs than entry via acquisition, and incumbent firms are likely to be slow or ineffective in responding to a new entrant's efforts to crack into the market. A joint venture to enter a new business can be useful in at least 2 types of situation. First, the joint venture is a good vehicle for pursuing an opportunity that's too complex, uneconomical, or risky for one company to pursue alone. And second, joint ventures make sense when the opportunities in the new industry require a broader range of competencies and know-how that an acquisition-minded company can marshal. Once a company decides to diversify, the first big corporate strategy decision is whether to diversify into related businesses, unrelated businesses, or some mix of both. Businesses are said to be related when their value chains possess competitively valuable cross-business relationships. These value chain matchups present opportunities for the businesses to perform better under the same corporate umbrella than they could by operating as standalone entities. A related diversification strategy involves building the company around businesses whose value chains possess competitively valuable strategic fit. Strategic fit exists whenever one or more activities comprising the value chains of different businesses are sufficiently similar to present opportunities for transferring competitively valuable resources, expertise, technological know-how, and other capabilities from one business to another. Cost sharing between separate businesses where value chain activities are combined. Brand sharing between business units that have common customers or draw upon a common core of competencies. Businesses are said to be unrelated when the activities comprising their respective value chains and resource requirements are so dissimilar that no competitively valuable cross-business relationships are present. The task of building shareholder value via unrelated diversification ultimately hinges on the ability of the parent company to improve its businesses via other means. To succeed with a corporate strategy keyed to unrelated diversification, corporate executives must Do a superior job of identifying and acquiring new businesses that can produce consistently good earnings and return on investment. Do an excellent job of negotiating favorable acquisition prices. And do such a good job at overseeing and parenting the firm's businesses that they perform at a higher level than they would otherwise be able to do through their own efforts. The procedure for evaluating a diversified company.
Okay, we're going to stop here the video. We don't need to continue watching because I'm going to explain a little bit about the last part, about related and unrelated businesses. Well, when talking about diversification, we're talking about, like I told you before, like putting the eggs in different baskets. It consists on expanding the range of business activities carried out by a firm. Firm is a company, right? Or a corporation. Carried out by a firm away from the present product line and market structure. All right? So here I decided to paste this picture because we already studied this so you can understand it better. So let's say that you want to invest, maybe not exactly in a different line of products, but maybe in the stock market or mutual funds or commodities or bonds. This is other way to diversify the money. All right? It involves search and selection of new business areas. This is my favorite one. Formulation and implementation of an entry strategy. And here is when we are talking about related and unrelated businesses. For example, let's talk about Coca-Cola. As you know, it's a very famous soda. It's a very famous drink. If you pay attention to the different line of products they have, you are going to see that they have water and they have other brands, different colors of sodas, right? But basically, it's the same type of business. They are related. We're talking about drinks, right? Water or soda, yes or no? Yes, right? But for example, look at this picture. Everybody knows Ferrari. Everybody knows about this brand and recognize even the red color. It's a very famous color. People say it's red Ferrari. Very famous color. Most of people know this brand because of the car. Beautiful red Ferrari. Some people know also other products like the clothes or the perfume, as you can see here on the right. So this is an unrelated product because they start with cars, all right, transportation, and now they have other kind of products like fashion or body care with the perfume. In this case, there is not a relation between one product and the other. And this is other homework you are going to have, okay? So right now, think about a brand, a company that have different products that they are not related. There is nothing to do between one product and the other. Okay, so that's curious, right? It's like, okay, how can you connect a perfume and a car? Well, Ferrari did it. And there are a lot of brands like this. If you go to supermarkets and you pay attention on the name of the factories, you are going to see and you're going to be amazed of the amount of products that some companies do that you wouldn't believe. I can tell you more examples, but that's going to be your homework. So you just do a little research about that. All right? So I hope you like this class and that you learned something good. Because about investing and about diversification, it's important not only on businesses, but also in your personal life, on your personal finances. Why is good diversification? Why is it good? Well, some of the advantages are that they increase flexibility. Flexibility means that you can move from one business to the other, or you can move your money from one business to the other. It increases profitability because you don't have only one business, you have two, or you have two sources of money or more, not only one. It has the ability to grow quickly, better access to capital markets. It avoids anti-monopoly legislation. Monopoly is when only one company is the only one that sells the product to the whole market. Like no one else sells that product. Like maybe if you talk to your parents or your grandparents 20 years ago, the only company that sells TV cable was TV Cable. That was the name of the company actually. And they provide that service. And it was the only one in the whole country. I'm talking about 20, 25 years ago. So only some people had this service and they had the monopoly because no other company had that service. All right, and my favorite advantage is that you diversify the risk. It means that if you lose in one business, you don't lose everything. And this is one more time the explanation of the eggs in the basket. As you can see in the right, the disadvantages are not so many. No synergies. Do you know what synergy is? It's like moving from one place to the other. No additional benefit for shareholders, so it's the same for them. No advantage over small firms. It's pretty much like the same, one more time. And lack of management focus. It means since you are going to have your money or you are going to have different businesses, your attention is going to be kind of diversified too, right? So you're not going to be focused only on one business or on one source of money, but in two or more. So it's going to be kind of distractive. All right, so from my point of view, one more time, diversifying or diversification is a good way to make your money grow and also to save your money or not to risk all your money. It's like when you go out, I don't know if your parents told you this, at least in my house they told me once. And now that I'm your teacher, this is my advice for you too. When you go out and you have some money with you, don't your parents tell you to put your money in different pockets? Like you put one bill on your right, one bill on your left, other bill in your wallet, sometimes in your shoes. Well, that's diversification. So in case something happens, you don't lose all the money, right? Maybe only one or two bills, but not everything. That's why it's a huge advantage. This diversification of risk. The last one here on the left. All right, I hope that you like it, that you learned a lot today. Please take care, stay home, wash your hands, and see you next week, everybody. Have a wonderful day. Bye-bye.